39.6 Facebook and YouTube Live Finance Show, Getting to Zero Tax Part 3, Schedule C, Business Gains and Losses. This is 39.6 Facebook and YouTube Live Finance Show. This is the show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, real estate, taxes, syndications, paying for college, even the car you drive. In today's episode, we are going to continue tax week. We've covered Schedule A, itemized deductions. We've discussed tax credits, and we've gone through Form 1040 back in episode number 83 with the Physician on Fire's tax return. If you can hear me, please let me know in the comments. I'd appreciate it. All right, Schedule C. So here we have, just briefly, in Physician on Fire's tax return, we have in line number 7A, it's a little small, I'll make it a little bigger. Okay, in line number 7A, it says other income from Schedule 1, line 9, and he had $286,000. That's basically his business income. Now, they used to have a different form, a different schedule that plugged directly here into 1040, but they don't have that anymore. They have, in an effort to simplify the form, they basically made forms go to other things called schedules. And so Schedule 1 is what you see right here, and it says additional income and adjustments to income. And in line number 3, it says business income or loss, attach Schedule C. So Schedule C goes to Schedule 1, and then Schedule 1 goes over to the 1040. So I'm going to unshare this one, and I'm going to bring in the actual Schedule C. Okay, so here is Schedule C. Profit or loss from a business. Now, one of my pet peeves that a lot of people say online is that you need to have an LLC in order to get deductions for your business. And that is absolutely not true. An LLC does not generate new deduction opportunities like business expenses. Okay, now filing as an S Corp is a completely different thing. That's how your tax filing status is. But having an LLC is a state level entity. It is not a federal tax associated thing. So there's this thing called Schedule C, where anybody who makes money doing any business activity, not as an employee, can report their income or losses of that business. And you do not need an LLC to do this. An LLC is to protect your assets of the business. If your business has no assets, the LLC does not necessarily provide you much benefit. An LLC can provide anonymity, but it does not really protect assets if you don't have any assets in that business. So if you're a 1099 contractor with no assets to that business, you don't necessarily need an LLC to do that. So you can directly report on Schedule C. Now, you can also create what's called a DBA, a doing business as. So if you don't want to do work under your own name, but you want to have a business name, you do not need to have an LLC in order to have a name for your business. Okay, so you just file a DBA with like your county. It costs like $20 or something, and you get it notarized and send it in, and it gets registered. And now you can have a bank account that has that name for your DBA, you're doing business as. And you can have all these official things without having an LLC, okay? And even if you do have an LLC, it will often flow right here to Schedule C regardless if you're a sole owned LLC, basically a disregarded entity. it just flows directly to your personal return onto Schedule C. Okay. So Schedule C is profit or loss from a business. You put your what the business is, like what it is that you're doing if you're a physician, or if you are a teacher and you're doing, or a tutor and you're doing this on the side, and you can have a business name below it. You put your business address. You can have either a cash accounting method or an accrual accounting method. It asks if you materially participated in the operations of the business to support that you are actively involved in this. Okay, asks if you made this as a new business in the tax filing year. Then you get down to here, Part 1, income. Okay, so this is confusing for a lot of people because it's written as if you're like a store. So if you're a store, you have to buy goods at wholesale and then you sell them at retail. So line 1 says gross receipts or sales. And so if you're a store, you would put all of your receipts right there. If you're not a store and you're just a 1099 contractor doing work and getting paid for it, I was like, where do you put this? Like, this is really Schedule C the right place to put your income. But yeah, you put your income over here, and that's where you basically indicate that you earned money. Okay, even if you're not a store, you still earn money. It's still considered part of your gross receipts. Okay, so basically that's it. Line 1, and then line 7 is gross income. Okay, it's that simple. Then you have your expenses. All of your expenses for your business. And Schedule C is not specific to any type of business. That's why it asks at the top to tell them what kind of business it is. And there are certain IRS codes they have for different businesses that help them kind of audit it quickly to see if the numbers make sense. Okay, but line 8 is advertising. Okay, any business can have advertising costs. 9 is car and truck expenses. So if you have a car and you are self-employed and you have a home office and you are taking a deduction for the mileage you have between your home office and your job, okay, that's a place to put it. Or you could be depreciating your car and putting it there. Okay, commissions and fees. So if you do sales, or if you do something and you have somebody who helps you sell something and you provide them a commission, okay, that would go there. Contract labor, if you have people like an accountant or let's say you have like a repair person doing some contract labor work. Line 13, however, is a big one. And it's interesting. I mean, it's all in alphabetical order here, but to me, this is like the last line item, but depreciation and Section 179 expense deductions. Okay, so if you bought something and you are going to depreciate it, that goes over here. Or if you're going to take a Section 179 deduction where you basically deduct the entire cost of it right now. You can do that with vehicles that weigh over 6,000 pounds of gross vehicle weight. So there's certain cars that allow you to write off the entire value in the first year. Okay, but depreciation is gigantic, and this is where a lot of people can get a negative number out of their Schedule C. So let's pretend you have a business and you bought some expensive equipment, or you bought a building for your business. Okay, you can depreciate that building, and even though you don't pay for the entire value of the building up front, because most companies and people will not buy a building in cash, you'll buy it with a mortgage. Regardless of how you pay for it, you can still depreciate the entire expense of that building that isn't the land. Okay, and so historically you would do that over a certain amount of time, like over 40 years perhaps. Okay, we'll get back to that in a second. Okay, other expenses, employee benefits, insurance, interest like mortgage interest, or any other interest you have like on a loan. Then you have other office expenses, pension plans, profit sharing plans. So this is like if you have a cash balance pension and you're self-employed, you could put that right there, or a solo 401k. I can go right over there. I think, depending on, it's either there or on 1040. But this is where retirement deductions basically take income off of your business income, so you don't pay tax on it. Rent or lease of equipment or property. So if you're leasing out an office space, it would go here. Repairs and maintenance, supplies, taxes like property tax, travel and meals. If you are traveling for a business purpose or eating for a business purpose, there are deductions for that as well. Utilities and wages to other employees of your business. Okay, then they have other expenses. But we'll get back to depreciation. So you buy a building and it's supposed to be depreciated over, let's just say, 40 years. That building is worth $1 million. The land you cannot depreciate, but the building you can. So the building, let's say, is worth $800,000 and the land is worth $200,000. $800,000 for the building. You would then divide that over 40 years for straight line depreciation, and you would get a deduction of $20,000 per year. Even if you didn't pay $20,000 in that first year to acquire the asset, you would get to deduct $20,000 as a depreciation expense. So let's pretend you're starting your company and in the first year, you are a complete wash. The amount of money you spent and the amount of earnings you got are equivalent, okay? And by spent, I mean in terms of all of the other expenses that are tax deductions, okay? So you're a complete wash. Your cash flow zero, cash flow neutral. But then you get to take $20,000 of depreciation. So your total expenses are now $20,000 more than your total income. That gives you a business loss of $20,000. That $20,000 loss will then go to Schedule 1, and then it will go over to Schedule to the 1040. Okay, and that will go as a negative number on your 1040, and it will offset other ordinary income you have from wages that would otherwise be taxed at your marginal tax rate. And that's just taking straight line depreciation off of that building. Since September of 2017, when the new tax laws rolled around and became effective for bonus depreciation, you can actually take off way more than that 4% of the value. Okay. Well, I said divide it over 40 years, so 2.5% rather. And I'll cover bonus depreciation separately at another completely separate episode. But you can also just do what's called a cost segregation without bonus depreciation. And I did mention this in a previous episode before, but I'm going to go through some real nuts and bolts numbers in a subsequent episode. But let's pretend you could write off $200,000 in depreciation in a single year. You could generate negative $200,000 on that Schedule C. This is gigantically powerful because now you could earn $200,000 of wages somewhere else and your income goes to zero and you're paying zero tax. Or you could have $224,000 of income somewhere else, and here this negative $200,000 brings you down to $24,000, which is the standard deduction, or slightly below the standard deduction for a married couple, and you'd have zero tax. So it's very easy to imagine how you can get to zero tax when you're taking massive losses in depreciation, and you don't even have to pay for the entire item. You just have to have enough to acquire the item, which could just be a small down payment. But then you get to capture all of those losses in the year you acquire the asset, generating a bunch of negative numbers, which really drives down your adjusted gross income. If you do this with a number of buildings, you can very easily see how you can bring your taxable income completely to zero. Okay, particularly when you own these real estate assets that allow you to do bonus depreciation. Okay, that is it. It is late night here. That is it for episode number 90. Thank you for joining. Until tomorrow, we do episode number 91. We're going to hit episode 100 in a week and a half. That's crazy. Again, this is only for my entertainment, maybe yours. This is not legal, medical, financial, or tax advice. Until tomorrow, have a good night.